Hello, Buff fans. This is your host, Lee Stitzel. I'm happy to present this episode with Dr. Jim Owens. Dr. Owens is going to talk about executive compensation. This episode was recorded in early March, just before the COVID crisis forced our university completely online. So we're just now able to present this episode. The consequence is that Dr. Owens makes some references to current events that were happening in early March. I think they're interesting. They're still pertinent. You should be able to sort them easily. I just wanted to give you context, and happy listening. Hello and welcome to the EconBuff podcast. I'm your host, Lee Stitzel. With me today is Dr. James Owens, Professor of Finance and the Hodges Professor of Corporate Governance at West Texas A&M. Jim, welcome.
Thank you.
So Dr. Owens is the longest tenured professor at West Texas A&M and has taught here since 1978. He also teaches banking executives at the Pacific Coast Banking School. So Jim, our topic today is that of executive compensation. I think it's a good time to talk about that. It's a very hot topic, both sort of politically and just something that people are talking about. So I think that's very interesting. I see a couple of concerns. One is that CEO pay sometimes isn't considered closely related to the outcomes of the businesses themselves. Hopefully we'll get to talk about that a little bit. The other thing is some stylized facts, and these are the ones that I've pulled. If you have some other ones that you'd like to share, we'd love to hear them. One is that CEOs often make 300 times the pay of typical workers, and since the mid-1970s, CEO pay for largely public traded American corporations has gone up fivefold. So our topic today then is executive compensation. One economist, and I'm going to lean heavily on his work today, is that of Tyler Cowen. He actually argues that executive compensation is so high because of competition. He specifically says there's very few potential high-level executives. They're very important to their companies, and that this is driving their pay up. How do you view that claim?
Well, I would make two observations. First is the fact that if you look globally, you will find an enormous number of extremely competent executive CEOs who are paid dramatically less, both in absolute terms and relative to their workers, than U.S. Now, partially that is a function of how we choose to pay our executives, and partially it's an issue we'll address probably in some detail, but more than 80% of their compensation is performance-based, and much of that is in the form of stock awards.
Mm-hmm.
We've been currently, until this morning, on a 12-year bull market. My guess would be that if I assess this executive compensation levels 6 months from now, it will be dramatically lower.
Right.
As of today, it is lower. So you have to look at the issue of where it comes from, and that is, in most countries, they are not directly awarded shares of stock, and that makes a substantial difference. The other issue, and it's a relevant issue, we are required, of course, in the United States by SEC requirements to have three main committees on the board. You have to have an audit committee, you have to have a compensation committee, and a nominating committee. They all must be composed of independent directors. The compensation committee is the one in charge of setting the compensation pay. Now, again, these are independent directors. They are not employed by the firm. The CEO cannot be on that committee because it's setting his pay. The issue becomes that most of them are not terribly well informed about
Is that right?
other CEOs. So what they do is they hire outside what are referred to as compensation firms who basically do this. They go out and find a peer group. They then assess the average or the reasonable CEO compensation of those peers, and then in turn they report back to the compensation committee and say this would be our recommendation. Now you have to appreciate that from a compensation committee point of view, one of those directors, by saying I agree with this outside firm, I have absolved myself of responsibility. I've managed to dodge, as they say, dodge the bullet. I'm just doing what the experts tell me.
Right.
I'm agreeing with their numbers.
Yeah.
The experts, by definition, are always encouraged to step your CEO slightly above the others.
Right.
So it's an upward spiral. And so I'm not sure that I would agree with Cowan's thing that they are necessarily more talented. I think that in many respects they happen to be in the right place at the right time.
Sure.
So there is that issue. There is also the issue, those extremely high numbers, 300 times our median now, you have to understand how they play with that. You can knock off your foreign workers.
Okay.
You can knock off your part-time workers.
Sure.
So what you do then is you try to raise the median to lower that number.
Right.
Now, some industries, by the nature, they can't get away with that. For example, if you were to look at some of the telecommunications companies, they are notoriously one of the worst in terms of the pay ratio, the ratio between CEO pay and general employees. The reason is you've got so many people who are employed 40 hours a week, but they're doing pedestrian jobs. They're hourly workers. They work for a salary. You can't knock them out of the average, so it lowers the median, which makes those numbers go sky high. To some extent, they're an aberration. There's only a few of those. Average CEO pay in the U.S. is around $12 million a year, including stock awards. Under IRS rules, only the first $1 million is tax deductible. So most of them have a $1 million salary. Then there could be some bonuses paid based on short-term performance. But the bulk of it, 80%, is in stock awards, either what they call stock appreciation rewards or outright options.
Right.
So in a sense, the board is awarding, for lack of a better term, funny money. It's not real. You can't reach out and touch it.
Yeah.
To
Hard to
them,
tax
they're
that,
just
right?
allocating 1 million shares of stock.
Yeah. So let's talk about that, because I think that's a very interesting topic. So for our listeners at home, give us some of the reasoning for that. One is sort of the tax implications, which I think are very important, because we hear a lot of rhetoric probably in the public about, oh, let's have these marginal tax rates. Well, you're just going to move that $1 million cutoff around,
Yeah.
right? If I start taxing above 600,000.
Then we'll just move that.
They'll just move it from $1 million down
Absolutely.
to 600,000. But there are some good things probably from assigning a big portion of your compensation to incentives that align you with the performance of the company. So can you talk about the principal agent problem a little bit as it pertains to executives?
The principal agent problem that is at risk there is you would like to align the interest of the CEO with those of the common shareholders.
Right.
Therefore, the premise has always been, and this goes back to Michael Jensen and Meckling when they first did the agency theory argument, that the executives need to have skin in the game. They need to own shares. And a way to do that was to award them these stock options or stock awards, either way. The motivation being to drive the price higher, therefore to increase their own compensation, and at the same time drive the price higher for the shareholders. That is slowly, and I think appropriately, beginning to change to where now more firms are saying, I will give you a bonus, but you have to buy stock. You own stock in this firm. You actually own it.
So do you view that as being even more skin in the game than
Yes,
if you have to buy
because
it?
now it's your money.
Right.
Now you have effectively, assuming they pursue that, you have a one-stock mutual fund. You are invested in the success of this company in a
Right.
big way because it's your real live cash money. Whereas if it's just what they call a stock appreciation reward, if the stock goes up, I will give you the difference between the starting point when I awarded it and the point at which I measure your performance. Usually it's done over 3 to 5 years. If that were to occur, I don't really have anything invested. in effect, what happens is I'm willing to take high risk to get that price high in that 3 to 5 year span,
Right.
and then cash out.
Yeah.
If I have my own real money invested, I'm a little less inclined to take high risk,
Right.
because now I'm risking my actual future. And so I think we're going to see more and more companies move in that direction, partially because of the public reaction about these excessively high pay ratios. You have to recognize also, coming out of Dodd-Frank, the pay ratio requirement that you have to publicize it. It has no teeth. It's purely embarrassing. And the problem is
There's no teeth, as in there's no punishment if
No
I
pun-
don't make
nobody
that
cares.
information available.
it's just out there, and very few people look at it. Right now, 84% of the stock in the United States is held by the 10% richest individuals.
Uh-huh.
So the other 16% goes to the other 90% of individuals.
Well, and how many people aren't in the stock market at all?
Over 50% who do
Right.
not own anything through a 401k, an IRA, anything.
So there's 50% of people that have nothing.
Have nothing.
And then what'd you say? There's 10%. So there's 40% that then have the last.
That has the last 90%.
Yeah.
And you've got to go, I don't know that very many people really read them. Read the pay ratios.
Right.
They look at them, I suppose, because some hysterical newscaster, as soon as they become public at the end of the year when Equilar or whoever puts them out, then it makes a fantastic opening statement. 5 minutes later, they're on another topic,
Right.
and I don't know that most people could remember.
So it's kind of interesting that we started off this podcast saying this is something that people are worried about and they care about. And then you're saying, well, yeah, but maybe only for a few minutes they care about it when they see that article come across in Forbes or Fortune or whatever.
Exactly. And then under Dodd-Frank, we also had the say on pay.
So tell us what that
Okay,
is.
the shareholders, you have to do it every 3 years. You are required to allow the shareholders to vote on their perception of the appropriateness of the CEO compensation. It's non-binding. Means nothing.
Sure.
It's just jawboning. It is just for publicity. On top of that, you have to recognize that over 80% of the shares of stock in the United States are owned by funds. Okay, so relatively little is actually owned by Joe Blow, the normal investor.
Well,
Most people own funds.
So most people don't want to own stocks directly. We want to diversify.
I want to
ergo we hold
diversify into
funds.
the funds. When you look at the votes in say on pay, the votes are primarily from the funds because they own most of the stock.
Right.
Over 90% approve.
So what's up with that? So as coming from my perspective, right, I feel like if I'm owning individual stock, me personally, and then I'm going up and then I'm thinking about, how do I vote or not, I feel relatively uninformed. Do you view the people that are doing that for the funds, are they well informed? Or do they feel like they're keeping an eye? Because my intuition would be those guys care about those stocks performing well. They care about who they're holding. They care about how that executive is performing. It seems like they have incentive to kind of keep those guys and gals that are at top of those big companies in check.
They would, except the vast majority of them vote according to two agencies, ISS, the Institutional Shareholder Services, and Glass Lewis. They make their living on advising funds regarding the individual stocks within those funds. Again, the argument being for a great many of the funds. For example, BlackRock right now, as an activist investor fund, has over $100 billion invested in a variety of firms. They don't take the time to investigate them all. So
How
they
could
just go
they?
to ISS or Glass Lewis and say, what do you think? Well, if they say, I think the CEO's compensated in comparison to others in the industry at a reasonable level, they just vote say on pay. They just, it looks good to me.
So it circles back to
right.
that committee that you were talking about that determines
Absolutely.
executive compensation. So it's a little hard for me to judge. It seems like you think that this is a problem, or at least sort of suboptimal. Is that a fair interpretation?
That's a
of
fair
your opinion?
interpretation.
So it seems like kind of one of those problems. We have so much information and there's so much out there that it can be hard to expect Joe Blow to vote on his stocks. Could even be hard to expect a mutual fund. But then, from the perspective of those two companies, they seem to have well-aligned incentives. But then at the end of the day, you're talking about two companies that are shaping basically everyone's view of executive compensation.
And the difficulty then becomes, if you are the head of one of those large funds, particularly one of the large activist funds, but almost any mutual fund, the more the CEO makes, the more you can justify your high salary.
I'm sorry, run that back.
Okay.
Who is that can do that?
Okay, if you are the chair or the CEO of a mutual fund,
Okay.
or even one of these
see.
activist funds,
Mhm.
and you say, I think that CEO at Company X is receiving a reasonable sum. Therefore, shouldn't I receive as much?
Mm.
It's in my best self-interest to approve higher CEO pay because it would result in my earning higher
Right.
pay. It just, in effect, in comparison to them,
Sure.
I should be earning equal amounts.
This is why.
It's an upward spiral.
Yeah. So this is why baseball players like it when other baseball players make a lot of money.
Exactly.
Because
And,
then their raise is coming.
Absolutely. And then that's why when I go into free agency, I am looking to, oh, by the way, you paid XYZ so much money and I had a better batting record last year.
Of course, the problem there is the players only have power in as much as they can negotiate.
Right.
Whereas these executives that we're talking about at the mutual funds have some of that feedback that
Yes.
causes some of the problem. Because I don't really think we think that there's sort of no intrinsic, there's none of the principal agent kind of problems that are happening with ball player pay. We can sort of maybe judge America for how much they like to spend on sports, maybe not. But those athletes, I think, are a very good corollary. And Cowan, in his book, Big Business, which I do recommend to the listeners, that's a book worth checking out for sure. He does make that sort of corollary there, and argues, well, your top players, your guys who make a difference, those guys are getting paid and they're driving that pay scale up. Do you see, from a talent perspective, that same kind of story for executives, right? It's hard for you and me to begrudge LeBron James making a lot of money because he's phenomenally talented and he's so much more talented
Right.
and so you don't even blame maybe a guy who doesn't pan out. You don't blame him for getting paid a lot because the team was willing to take a chance that he was going to be the next LeBron. Is that a good corollary for CEO talent? For those of us that work our normal everyday jobs, we look at those CEOs, and I think it's genuinely hard to tell. Are these like tremendously hardworking, intelligent, talented individuals? Or, as you said earlier, are these just good executives that are in the right place at the right time?
I firmly believe a lot of it is right place, right time. One, they are hardworking. I will give you that. There are some industries where the risk is abnormally high, and basic economics is high risk, high return.
Right.
Healthcare would be one, particularly with all this going on right now with the coronavirus. But healthcare, you bear two primary risks as a CEO. The first risk, of course, is liability if something goes wrong, and it backs back up to the firm and therefore to the CEO. So you always have a risk there that you could be gone in an instant due to an error, not necessarily of your making, but it was on your watch, right? The most common one would be Theranos, the lady who had the blood testing company, which turned out not to work, and now she will never be a major CEO in another firm. I mean, that's high risk. You're done. The other issue there.
So if I can pause you there.
Okay.
That has a certain appeal, right? Because if you're the person at the top making the big bucks, the buck stops with you.
Absolutely.
She didn't make any mistake in the production process herself, and
But
yet, like you said, it happened on her watch.
It's happened on her watch. And right now, if you say her name, you don't say the word CEO anywhere
Right.
with that name.
Right.
I mean, so there is that risk. There is also the risk that a lot of these industries are under enormous levels of consolidation. healthcare in particular, as a function of which, if you get bought out, you're gone. I mean, we don't need two CEOs. And it's very hard to find another spot. And that gets to the issue of how much time and energy you have invested in the company before you become the CEO. And the problem is, if you are then bought out, you are at an age where you can't start over again. So many of the CEOs argue, number one, I need to make a lot of money so I can salt it away in that event. And it's where the idea of the golden parachutes comes from.
So I really want to talk about the golden parachutes. I'm glad you brought that up.
Okay.
Before we get to that, I do kind of want to go all the way back to the beginning. So I opened this up saying executive compensation is so high because of competition. The argument there is the pool of executives is small and the demand for them relatively high. So that's a straightforward supply and demand version of that story. It makes a lot of intuitive sense if that's true. But you literally just said the opposite. There are a lot of executives out there who could do the job, and there are not many landing spots. That would imply that we have relatively low pay. That would push pay down.
It should.
Right? And
so oversupply.
So I think one of the things that oversupply then. So one of the things is, how do we view top level executives? Are there some of those men and women that are a cut above? They're the LeBron James, and so they're driving that up. But then your average executive, potential CEO, is going to be somebody that there's going to be a lot of them that are going to be very similar level of production, which is why we would see a big difference between the pay of top athletes and sort of just good ball players.
I think that is a fair thing, and I think I don't see a shortage of potential CEOs. Now, I'm not sure that most of the people who say, I wish I had the money, are willing to live the lifestyle.
So can you talk to us about that lifestyle a little bit?
It's 24/7. You're always at risk. Every word you say is parsed numerous times. I don't know how many people happened to see it last week. The tragedy at Boeing with the 737 MAX. Dennis Muhlenberg was forced to step down as CEO. He was replaced by a gentleman by the name of David Calhoun. Now, David Calhoun had been on the board of Boeing for 10 years. Last week, he had an interview with a New York Times reporter and basically threw the former CEO under the plane. His argument was that I don't know what, I think the words were, I don't know what happened to Dennis. I think he was chasing the gold at the end of the rainbow. In other words, I wanted profits and high salaries more than I wanted safety. Now, Calhoun's been on the board at Boeing for 10 years. So therefore, partially, he is responsible.
I was going to say, isn't he culpable there too?
He's part of the problem, not the solution. But he became CEO. He then throws Muhlenberg under the plane. He now has a massive morale problem at Boeing because he effectively just accused all the Boeing employees who were working under the former CEO of being part of that chase the gold. And the only response that he could get from the employees, and this morning he is backing and filling frantically.
Is that right?
But their response was, wow, really? Because you've just accused us of doing that. For a CEO, that is bald-faced incompetence. Most good CEOs come up through the organization. They know the culture. This man been in the board for 10 years, still didn't know the culture. And so you have to look at that and say, that's the best we could find? I mean, you found somebody who deliberately reduced morale at a time when it needs to be 180 degrees opposite. The FAA this morning has announced without any question you have to replace the wiring in the tail of the 737 MAX. It's not a big problem, but it's expensive. You've now got a whole group of employees who you've just accused of creating the problem. And you were on the board. So it's bad leadership. My guess would be they need to find another CEO.
So they need to make another switch.
They need to switch soon, because I don't think this guy can be effective at this point. Now, that goes to the issue. There are always insiders in an organization who I think have the potential. Now, whether they have the political skills to come through the chaos, whether they have truly the desire for the lifestyle. And it is harsh. Traveling, your family goes below number 2 in sequence of importance.
Right.
It's a harsh life. No, it's not easy. Everybody goes, oh, well, they get to fly in private planes, they make tons of money. Yeah, but most of them never see it. They're so busy working,
Right.
they don't see it.
Right.
And everything you say is parsed. Every word is gone over, and you've got, which means, and the unfortunate part is, from our perspective, it makes them all sound neutral. I mean, can you just tell me the truth? Well, I am in the most politically acceptable way that I don't think will get me in trouble.
He's not trying to tell you the truth. He's trying to boost the morale of his employees.
Exactly. And there's all kinds of these issues that shrink the pool of potential CEOs. I don't think it's talent. I think it's all the other factors.
So say that again.
I don't think it's raw talent. I think it's the other factors. The effect on your home life, the effect on your personal
Gotcha.
life.
Takes a certain type.
It just takes a certain mentality to live like that. And again, it's harsher in the U.S. because certainly with multimedia, everything you do is instantly sent around. For example, this morning they just Elliott Management and Activist Fund just backed off the CEO of Twitter, right, Jack Dorsey.
Right.
They wanted him out. Well, they've now agreed that if he'll buy back $2 billion worth of stock, Elliott will let him live.
So can we talk really briefly, for those of us not familiar, what an activist?
An activist investor is any individual, or in these days funds, who takes a position in stock. I mean, literally, I could do it with 10 shares of stock. I have the right to propose to the board that I think changes should be made. And there are a few of them that are very well known. Obviously, Carl Icahn is among the most famous, but Elliott Management, BlackRock, Vanguard, even Berkshire Hathaway, these people will all take positions in stock, and then they will suggest to the board, I think if you did X, Y, Z, change in management, change in strategy, we could be more successful. For example, eBay is under a lot of pressure right now to sell off its classified units. It's been pressed already. It's sold off PayPal, it's sold off StubHub, and now they're being pressured to sell off the classified units that is not making money. Go back to being what eBay was, an auction site, and be the best auction site in the world. Quit trying to spread yourself out. But it gets into those kinds of issues for the activists. How do I create value? Now, most of them have time frames 3 to 5 years maximum.
Even the activists.
Even the activists.
So that lines up with the CEO timeline.
Absolutely. It's a short timeline.
Yeah.
But the CEO has got to find a way to respond.
So this is something I did want to broach at some point, is this timeline thing. I think we do sometimes think these companies are too short-sighted. I'm sort of the opinion that the way that we see the world evolving and some of these longer bets not paying out, that maybe that's overblown a little bit. So maybe in a time period where the economy moves about a little slower, especially in terms of technology, that we don't have that might be a bad thing. That might be the kind of thing to be worried about. Okay, they're looking so short term because they care about the stock price, and really it's the long term health of the company. But we see several different things. One is some of these companies that seem to get to the top and stay on top longer, right? So sort of that classic technology company like a Google, Amazon, those kind of firms. So they seem to have found the balance between short term and long term. That's maybe just the definition of a successful company. I don't know. But we're living in an environment where you could make the mistake either way, too short or too long. How do you view that?
I think with the advent of technology and communication speed, social media, there are a lot of people who wish we were back in the 60s. Back in the 60s, inflation was a couple percent. High interest rates for a home loan were 4 to 5. You could make 3 to 5 on your savings. If things move slowly, I grew up in that era, so I remember how slowly they moved. Today, truly, I would like somebody to tell me in detail what my phone will look like 5 years from now.
Yeah, not possible.
And I don't think anybody can do it.
It's either going to be directly in your brain or it's going to be a hologram, right?
None of us know. Will you plug it? Will it be science fiction like The Matrix? Do you plug it into a socket in my head?
Yeah.
I don't know.
There are companies working on that.
Therefore, for example, the Samsung's flip phone with the foldable screen.
Yeah.
Okay, a year ago we were all laughing. It cracked. Now they're selling them. Now,
Is that right?
They're selling them for $1,100, but so I'm not about to buy one.
Dude, Apple sells their phones for $1,100.
Yeah, but it's one of those things where, truly, 5 years ago, would you have said that I'll spend $1,000 on a telephone and I'll give up my camera?
No way.
I mean, we all had 35 millimeter SLR cameras. We
Right.
thought it was incredible when they went digital and had to quit putting that stupid film cartridge in there and hauling it down to the drugstore to get it developed.
Absolutely.
We thought this is incredible. I have no idea what they'll look like 5 years from
Yep.
now. So to ask a company to be thinking 10, 15 years out, who knows what the technology will be? So I think short-termism is overblown.
Okay, so
They have
you're on
to-
the same page with me then.
They have to think short-term because things are changing so fast. If you are developing a product for a decade from now, believe me, you're going to miss the market because you have no idea what it's going to look like with the technology. We don't know what AI is going to do to us yet. We know artificial intelligence is coming. We don't even know for sure what 5G is going to look like when it's in full blown.
Yeah.
We just don't know. I mean, it may well be that will change the way we all interact. For example, here at the school, and I was one of the very first to go online. You back up 10 years and tell me I'd have people teaching all their classes online, I would have laughed at you. No way. It's going to be me in a classroom. We'll just be making eye contact. Now my eye contact comes through my screen, through Skype or WebEx or whatever. It's totally different.
Well, and that's the reason I have a job here is because you and my previous guest, Nick Gerlich, put these online programs,
Yep.
had a lot of success doing that. We're a pioneer here at West Texas A&M
We were.
in that. And I'm pleased to be part of that, especially the graduate
I don't know if
program
Nick
here.
told you a sidelight on that. He and I actually coded in HTML.
Yeah, he didn't say that.
Absolutely. Nick and I taught ourselves to code HTML to put the first classes online. We did it through Notepad, Word Notepad. You would code the little slash marks in HTML just the way the editors do now. And then you'd send it through and say, well, nope, that didn't work. And you talk about thieves. We would steal from anybody to try to find a piece of code that would work.
So let me ask you this as a bit of an aside here. So we have LMSs, learning management
Yeah.
systems. That's this, the sort of website that we run all of our online programs. Those are big companies that do that. I think there's only a couple of viable
Right.
options on that front, Blackboard and Angel and
Yes.
something else. So are you talking about before?
This is way before.
So you're talking about
Oh,
right
yeah.
in the original LMSs.
We were in the original ones, and we ran everything through Netscape Navigator, which most people never even heard of today. That's
Not
all
I.
we had. We actually had at WT our own shell. We had our own LMS.
So this was in '97 or
Yeah.
roughly about.
Yeah, back in there.
That's what Nick said.
So yeah, it was a fascinating time.
Okay, so that's '97. We're here in 2020, and it's just a completely different ball game.
And now we're looking at the coronavirus, and University of Washington went entirely online today.
Yeah, I was watching that.
And I would not be surprised to see it happen here. Just out of a,
This semester, or?
I wouldn't surprise me.
I mean, you could see the
just
value,
out
right?
of an abundance of caution.
So I'm going to go in front of my class tomorrow and say, listen, Don't be a hero. You don't have to come to class. If you're running a fever, we'll make it work.
We're
Don't
be
give
online.
your classmates coronavirus. And you're saying the next step after me telling my students to wash their hands is going to be,
Right.
let's just put it online for a couple weeks.
Let's just put it online until we're sure this is not going to get us.
And so what's wild about that is the environment changed so quick on that front. And now we're in a situation where, one, that would be viable, right? And two, I saw projections, and I can't speak to the validity of them per se. I saw it in passing, scrolling through the news, that there are projections that about a third of, like 93 million people in the U.S. are projected to get coronavirus because we won't take the kind of steps. And yet I could imagine this kind of thing like you're talking about being an enormous step towards fighting something like this. Could you imagine all the schools, all the universities being able to say, go home, download this app, do your homework.
Absolutely.
I'll sit in my office and record to this camera right here, and we'll just go on.
And we'll just continue on.
I know that Japan, in efforts to try to keep the Olympics on this summer, has canceled their grade schools, and so I don't know what measures they're taking to sort of keep the children educated. But imagine suppose that you lost the entire second half of your sixth grade year. That's a big developmental loss.
It is.
But if we can be learning from home, maybe we can mitigate that loss.
Maybe we can get through this.
Yeah, absolutely.
And there's an analogy between that and what we were just talking about with the CEOs. Okay? The analogy is, who's doing that?
You're
Who's
saying who's
putting it
having to make
online?
the hard choices there?
Who's going to be doing the work to put it online? It's you and me. Is the CEO, with all due respect to the president of the university, is the CEO doing that? And the answer is no.
No.
The answer is no. What am I? Like many people, as you get a little bit older, the packaging on things is frustrating. I actually own a plastic bubble cutter so I can get things out of there
Sure.
without cutting my hands in shreds. It's electric powered, for God's sakes.
It's crazy that even exists.
It should not happen. I cannot imagine being an elderly person with nothing but a knife and a pair of scissors trying to get into
Just
one of
asking
those.
for it.
My common thing has always been, what I would like to see happen is walk into the board meeting, hand it to the CEO, and say, tell all your minions to shut up and sit down, open that.
Really?
And if you did it, I'll bet you'd never package it that way again,
Yeah.
because he can't get in.
Right.
So somebody below him dreamed that up.
Yeah.
And that, I think, is something people don't recognize about CEOs, is that, in fact, most of them cannot do the work that they manage.
So let's talk about that a little bit, because one of the things that Cowan argues is that CEO skill sets have really broadened, and that has made the pool smaller, and that's made the returns to the CEO higher. Because we're seeing much more financialization. You have to understand a broader range of industries. You can't just know your individual business. That you have to understand much more in terms of regulations. You've talked a lot about public relations. That's a huge skill set that we want in our CEOs. You have to deal with globalization. Now it's not just enough to know about the U.S. I have to know what's going on in China and India and Europe and everything. So Cowan argues these people have become generalists. We've asked them for a broader range of things that they still be good at. You're saying that has come in part at the sacrifice of them knowing exactly what our company does. They're maybe more on that financial and public relations, regulations, globalized side. How do you see that fitting into the puzzle that we've laid out so far?
I think basically that you are quite correct in what we're requiring of them. And certainly it's a valuable skill. Nobody would argue that they should not be well paid for those kinds of skills. The issue is, however, they're not really running the company, they're representing it. They're making the decisions they make they're not who do we source from China. It's I think we should begin to source from China. And then it's because somebody's recommended we can do it cheaper, better, faster, until the coronavirus blew our supply chains apart. But the issue there is they're thinking in exceedingly broad terms. And that is, I don't know that it's an unusual skill, but it's an unusual demand because it's so easy to get wrong. And that is a problem. But in terms of, well, let me rephrase it. Let me put it back to WT. I've been here through, I think, 6 presidents now. I think 5 or 6. And with all due respect, they were all delightful gentlemen in their own ways, each one of them. Honestly, Lee, Mondays this afternoon at 1:30, teaching governance will not change.
Right.
It hadn't changed in 42 years with 7 presidents.
Yeah.
My job doesn't change. Now, the demands I make on them have changed. It has very little to do with the classroom. It has to do with promoting the school. It has to do with trying to get us to see things globally, for example, that we now try to attract students for diversity reasons from other countries. The skill requirements have changed. Whereas when I first came here, I mean, you would see them walking around campus, and many of them taught a class. And that is very rare anymore. That is not a normal thing. The same is true of CEOs. A small company CEO walks around on the floor and knows everybody, knows how the product's built. As the firm gets larger, that separation becomes greater and greater. Number one is because we require skill sets. Number two, that's what creates the risk. That's where you can make the mistake. You no longer, for example, at Boeing, they no longer knew what was happening on the floor. The emails that were flying back and forth between the employees at Boeing, laughing at the FAA, laughing at the management of getting away with things, is an indication that somebody should have been walking on that floor. You should have gone down and talked to the engineer. How are things going? You know, you're putting all these screws in the motor. How's it coming? But nobody ever does.
They're running that company from spreadsheets.
They're running it from paper. And for many years, I helped a good friend of mine at Key Bank in what they call problem loans. In other words, they're going bankrupt. And I was an expert witness. If we had to go to trial, and other than that, I would try to evaluate what I think it was worth, and we'd try to find buyers. My friend Dick Hooper, who was the head of that department at Key, made the observation with extreme conviction, and I came to agree with him, we would never have made this loan if that lender had gotten out of his chair and walked out to where he was lending it. If you had just gone to the place and walked around, you wouldn't have loaned it.
And that's not even an executive. That's somebody whose
That's
job
just
is to
some
make
poor
loans.
guy doing his job. He's living on paper. That's what we're asking the CEO. That's where the risk occurs. You've got paper and you've got reports from minions, but minions don't want to make you unhappy. So they say positive things. You're always right, you're always handsome, your hair looks good, etc. How do you get the data you need to avoid that company getting in trouble? And you being held responsible because it's on your watch, and you're going, I had no idea that was happening. I'm certain that Muhlenberg at Boeing did not know the shortcuts they were taking on the MCAS system. That they had gone down to, they made it, the problem is there was only one flight sensor. And you could have an option to have a second one. Should never have been an option. Any engineer will tell you always have redundancy. Always have redundancy. They didn't put redundancy. But I doubt Muhlenberg ever knew that. If he had, I'm sure he would have said, what are we talking, $100, put the other flight sensor on. But he didn't know that. And as a consequence, Boeing got in trouble, stock price fell, he lost his job. None of us, I mean all of, not, I don't say none of us, great many of us are going to be very hesitant to climb on that 737 MAX, all because of a cheap flight sensor that really somebody low in the organization chose not to put on to save a few bucks. But I bet the CEO would have done it, but he didn't know. And that's one of the reasons you pay them well, because that's a risk they take every day.
So let's tie a couple of things there, because you brought up one of the things that I do want to talk about a little bit, which is CEOs help large firms more than they help small firms. And so at the top of the size of firms, it's more and more important that you have a CEO. The returns to that get larger, just sort of like a basic leverage idea, right? And then you talked about very early on how it is that they're getting compensated based on stock options. And then you said, I think you said we saw an almost 1900 drop in the Dow today, or at least it was last we checked. It's been a minute. It might have fallen even further. And so there you expect like that'll be reflected in future compensation. I mean, obviously it is because they have some of those stocks. And so in part, CEOs as companies have gotten larger, they've gotten more global, their skill sets have gotten broader. You've mentioned from the get-go, part of what you're compensating them for is risk, and that risk is going up. The bigger the company, the further you get away from the ground floor, the more risk, the harder it is. And that there's this sort of causing the market to go up, or as the market goes up, your compensation goes up. So we see a relatively clear picture then of kind of how it is that we've got here. We have some sort of negatives about what's the feedback mechanisms of how the nitty-gritty, the details, the mechanism of how they get paid. But sort of the overall picture is these are people whose jobs you probably don't want, doing, pouring their whole life into this, working very hard, taking on a lot of risk. So it strikes me that the story you're saying is you're not as worried about executive compensation itself. That doesn't bother you, but like it seems organizational structure seems to have maybe systematic flaws. Do you want to comment on that?
I think that is where the flaw is most of us we are determined to please the boss. We perceive that to be in our best self-interest. May not be in the best self-interest of the boss or the company. But most people just can't bear to be, and partly it's culture. We don't like negative people. We make a big issue about that. Everybody should have dimples on their cheek and smile. I mean, that's just a requirement of life, and it's just part of our culture. But as a consequence, you have people who don't know what's going on, and that puts them at risk even more. And it's not that you intend to do that, it's just part and parcel of the way we work. The other issue, I think, going forward for a lot of these CEOs is we condemn so fast now. You're guilty immediately. And for example, there was a lady on the board, a lady by the name of Quigley, who received some material from the FAA.
At Boeing.
At Boeing. She's on the board. And she responded back to the FAA, why are you sending this to me? Shouldn't this go to the department that it involves? Immediately, she was branded as not being an effective board member because she was not paying attention to that. And she was off the board.
That seems pretty reasonable on her part.
And to me, that would be something I would say, did you mean to send this to me? Wouldn't that really go to the department that's doing this? Maybe you misrouted. It was totally taken out of context. She was not an appropriate board member because she's not paying attention to these messages. And you go, that's a very quick judgmental position. And that's characteristic with social media, with the speed of telecommunications, with the fact we don't all get the full story, and we just, bang, you're guilty. Well, all you got to do is watch Twitter. I mean, I try not to because I have a hard time with the first four letters of it, because I came from a culture where if you were a twit, you were, that's about as low as you could get. But when you look at some of the stuff that comes out about these people, you've got to go, who would want that? Who would want that job? Now, when you look from the outside, you say, geez, this would be great to be a board member. The average board meets 8 times a year. Right? So you've got to have access to all the information relevant to your position on the board 8 times a year? Okay, I'm paid $250,000, but I don't know if I really want to do that. I mean, that's all I got to do is make one mistake.
Well,
Say it wrong one time, boom, it's over.
I think the listeners are probably saying, well, that does sound pretty bad. In order for me to take that position, you have to pay me a lot. Ergo, why we see those people get paid a lot, maybe.
Yeah, it is. Plus, which fact, I'll pose a simple math problem to you. Take the CEO pay. Take the highest one you can find. Oracle's one of the biggest. Divide by revenue.
So just normalize it.
It's down below 1%.
So there's a part in Cowan's book where he says different labor economists try to estimate how much of your marginal productivity do you capture in pay. We do this as an exercise. So for our listeners at home, one of our fundamental arguments in economics is that you're getting paid by your marginal productivity.
Mm-hmm.
And so that means, how much more are you producing? How much are you adding to the company on the margin, right? Given the conditions that you're in. And so Cowan shows some studies, and I'm not familiar with this literature, so I'll take his word for it. But he says, the average is something like 80-85% for your typical worker, and that CEOs are capturing something like 60 to 70%. So that jives with what you just told us about how much of the revenue, going to the CEO. And I've always, this may not be a good way to think about it, so it might be a good question for you to turn your attention to. CEO compensation is a cost to the company. And so you'd feel like the board and these committees that you're talking about would want to treat it like such. Do you think that's how they view that?
No. To them, it's free money.
What, to the board?
To the board. Because the stock awards, you're just handing over shares.
Gotcha.
And what most people don't understand is the number of shares outstanding typically is a fraction of the ones that are authorized. Most companies will authorize vast number of shares, more than they've actually issued.
So for our listeners at home, explain what that means, authorized versus...
Somewhere in the past, the shareholders have said, we grant the board the right, for example, to issue 50 million shares of common stock. The board has only issued 10 million. You've got 40 million shares that you have permission to issue at your will. So when they give it to the CEO, they're just dipping into that pool and saying, here's 1 million shares. But to them, it's not real. I haven't really given you cash. It's not going to come out of the company's checking account. I've just given you some authorized but previously unissued shares. I will make it legitimate by saying it's going to take you 3 to 5 years to vest it by meeting performance goals. Perfectly acceptable. But from the board's perspective, the compensation committee really, because the board usually just approves what the compensation committee says, I've not really spent anything. I've just handed over more shares of stock. So yes, I have diluted the shares, but proportionally it's pretty small. It really isn't going to matter much. Plus, which fact, for most individuals, even if they own shares and they receive a proxy statement, they don't read it, one. And two, I read them constantly for my governance class. It's called the DEF 14A. You can go to Edgar, the SEC site, any company that's publicly traded, and you're looking for the DEF 14A, DEF 14A. And that's the proxy statement. If you dig deep in that, it has to state the total compensation and what the pieces are for each senior executive. Most people are never going to go look at that. They'll never know that it's even there. If I send them the proxy statement, it is 70, 80, 90 pages. Most of it is legalese boilerplate. You've got to dig your way down to that one exhibit that says, here's what the CEO makes. I would argue very few people, even fund managers, don't go there. It's just, I do it in class, and I can see the eye roll while I'm scrolling down through all of this gibberish trying to get to the piece I need. And it's just something that, again, yes, I'm paying them, but I don't feel that I've really spent anything.
I find that so fascinating. That's amazing that you've laid that out that way. That literally changes my view, because I had this sort of, I mean, it's factored right into their expenses, and you're saying, well, yeah, $1 million is,
Yeah.
but the other 12 million they're getting paid are in stocks we issued that we're sitting there just diluting.
They're just sitting there anyway.
It's a little bit of diluting our stock. That's all
Yes,
we've done
and most board
by
members
a fraction, probably.
most board members don't own enough stock to really care about
Is
the
that
dilution.
right? I was
No.
gonna say we may want them to own some stock too. So
Most companies require it, but it's very minute.
So you've painted a picture, and we've kind of encircled a topic here that I wanted to bring up with you. You teach corporate governance. I
Yes.
think that's even the class you're talking about. We're saying
Yeah.
you're scrolling through things and showing your students these kind of things. One of the other arguments that Cowan makes is we'd be worried sort of from like a moral issue that there are reasons these CEOs are getting paid that aren't due to performance. We've talked a lot about the performance reasons that executive compensation has gone up, so you don't see it as this huge problem. There are different parts, like you're saying. This new idea about it's not factoring straight into your expenses for your firm, and this other idea about sort of the mutual funds and some of these executives having sort of a part of the feedback loop where they would actually want to encourage this upward spiral,
yeah.
as you've said. Nonetheless, though, Cowan makes the argument that these CEOs actually have to deal with tighter and better corporate governance than ever before. And part of the evidence he gives for that is that outside hires of CEOs were only 15% in the 70s, and they're up to about 25% in the 90s. I don't know where the numbers have gone since then.
They've gone higher.
And so you talked about that idea of hiring somebody off the board to be the CEO. Well, I think an outside observer would say, well, of course that guy's getting paid a lot. These are his people. That's a little nepotism there.
Yeah.
That's getting them pay. So it's a good thing probably that we see these outside hires climb. So can you talk about those two things, this idea that corporate governance is tighter and it's better than ever before, and so we probably should be less concerned about that. Outside hires is going up, but I'm guessing still inside hires make up the majority of hires.
The
at CEOs.
inside hires make up the majority. We're going to go outside in a big way. And let me tell you why I think it'll happen. A large number of the people who are candidates are in their 50s and 60s, right? Because they've got experience in the firm or with other firms. The current, not craze, the current drive in corporate governance is what we call ESG, environmental, social, and governance. You have got not only to prove that your firm is environmentally conscious to avoid punitive risk, violating the law and being punished legally, you must now demonstrate to investors that you are taking a solid action to move forward on environmental issues or on social issues, and you're improving the governance. The issue is those are the demands of the millennial investors, and the ESG funds have jumped by over 200% in the last 5 years, and they're going to continue to go. That's a younger group of new CEOs. Those 50s and 60s, to them the environment, yes, I don't want to drink nasty water, but as long as my company's okay, I don't have a problem. What the new investor's demanding is not only do you not pollute the water, what are you doing to make it even better? And that's going to require a new group of younger outside CEOs, because they're the ones who've grown up with those social needs. Lord bless them for doing so. But they're very cognizant of this, and it is going to be, if you go to any governance conference or any publication, you will see ESG over and over and over. Now, we started out about 5 years ago with what they call CSR, corporate social responsibility. That has now morphed into this environmental, social, and governance, because there are funds out there that basically the millennials have demanded every stock in that fund must satisfy minimum standards on environmental, social, and governance factors. And not just meeting the law, but how are you improving? How are you enhancing those activities? So I think you're going to see a massive turnover, and I do think they'll come from outside, because you won't have that focus if you've spent 25 years inside the company doing it the way we've always done it. Now I want somebody with some new thoughts. So I think if I were a young manager, I would tie myself into one of those companies, and I would be on the forefront of that, because I think that's where you're going to get your new CEOs. We'll be surprised if you don't start seeing a change in boards. Younger boards, more diverse, who are more sensitive to these issues. And again, I'm not faulting the older people. I mean, I'm one of them. We were not brought up that way. We were just brought up, pick up your trash. You know, don't throw crap out the car window. Now you've solved your contribution to environment. You know, my dog and I go for a walk every day, but twice a week we take a plastic bag and we clean one of the parks over at the school. You know, we pick up trash because most people are slobs, so it gives her something to do while I'm walking around, and gives me something to do while she's running around. To us, boy, we really did something for the environment. No, we're talking about major corporate investments in environmental enhancement, in social improvement. That's going to be a new generation. That's going to be a younger group of people who grew up with that mentality. And it's not that old dogs can't learn new tricks, they just don't learn them real well. You know, yeah, I can learn to sit, but I can't do it for very long. So it's going to change, I think. I would be surprised if you don't see the disparity between CEO pay and employee pay decline as that occurs. Because again, they're going to be more sensitized to those governance issues. It does not enhance morale when it becomes obvious the CEO is making so much more than the people who's, as they say, where the rubber hits the road. So I would not be surprised to see this somewhat as a nadir here soon, and us start seeing that back off a bit. Because we've seen it in Europe, we've seen it in Japan, where basically, yeah, you make more money than the average worker, but not the levels we're seeing here. And I think it's just a different generation, which I think is great. I mean, that's where the innovation is going to come from. You got to love it. I mean, I don't know that I will benefit from all that gain, but somebody will, and I think, you know, my grandkids will, and it should happen. But I'm not faulting the older people either. You're not trained in it.
Yeah, times change.
It just...
You're painting a very hopeful story there. There's so many things to like about that, you know, where I think sometimes I'm disenchanted with, you know, the political environment. I think we all are.
Mm-hmm.
Probably not alone in that. You know, but I also, I would advocate, this episode isn't about climate change or anything like that, but, you know, I would advocate for certain types of policies, you know, but neither do I think that it can be the case that we can just sort of, by sheer political will, you know, cause us to get to a place where we live in a sustainable place and we, you know, improve the environment, like you said, hopefully for your grandkids, for my grandkids, and so on. So this idea that you're saying that literally the markets, the funds, the activist funds are out there pushing the corporate world towards these type of practices,
yes,
is very promising. So are we talking about you're making it sound like it's already a pretty significant movement that is gaining steam.
It's on its way, and again, there's no turning back. I mean, this is on its way now. Right. Again, you've got moving into positions of not only authority but economic power is that generation, those 30 to 40-year-olds who came through, and then behind them some 20-year-olds who are even more enthusiastic and very technologically adept. But I would not want to be a CEO with my company accused, for example, some years ago in India, where they were dumping the stuff in the rivers, dumping some very difficult chemicals in the river. In today's world, that CEO would be gone within days, yeah, because of the publicity that would come out, and the fact you've got a group of young people who are on top of that. They just don't put it. If nothing, I don't know how many of you watch. If you watch some of the tragedies that have occurred, India, Yemen, Syria. If you ever watch the films on the BBC, there are horrible victims with iPhones, video recording these atrocities. Who would have imagined that?
Yeah. Poverty is not the same today. As much as we dislike poverty and would like to eliminate it, it's not the same
It's not
thing.
the same. These are people, the people who are fleeing Turkey, heading for Greece, have iPhones with them.
I saw some of those videos too.
And they're showing the videos of what the Greek soldiers are doing.
Yeah.
Well, that's going to change things here at some
Absolutely.
point. You can only fire on those dinghies X number of times before people react.
Yeah.
The same is true of the corporate world.
Right.
You just cannot, you can no longer get away with things that maybe 5, 10, 15 years ago, you say, that'll slide. Not today. Not today. And that, again, if I was that CEO, that's a risk. There I sit. Now all of a sudden I'm guilty. And Muhlenberg at Boeing, if you ask him back in the beginning, what's an MCAS system on your plane, he would have zero idea. But he's out of a job.
So I wasn't expecting today to come in here and have so much hope infused into the story, where I think our listeners probably have that sort of general sense, and maybe it's overblown, maybe it's one of those things that social media distorts our view of the world and our view of how other people see the world. But you said a couple of really important things here today. One is executive compensation. It does have some problems. It's definitely not this super rosy story in some sense, but there are reasons for what it is that we're seeing going on with trends in executive compensation. You even just a minute ago said you think probably that disparity between those, between your what Cowan calls a typical worker, you call them the median worker, which I assume refers to their median income or pay, and the top, that you think that'll go down.
Yes.
And also this story about how companies, corporations are becoming more and more sensitive to social values and environmental concerns, both of which are probably very, very good things. And so, I think when you look at it from the perspective of why is it that somebody's in an educational role like you and me, right? We love nothing more than have students really listen and learn and think and come to their own conclusion, even if they don't get to the place where I am in terms of what I believe. Watching them think and learn is very important. I think you've highlighted today a really important thing that we can do, which is step back and break down why is it executives get paid this way and what are the problems, right? Because I think there's probably a general notion, and again, maybe this is my distorted view based on my social media interaction, that CEOs just pick their pay, and then I think having a real explicit understanding, they're doing this based on these committees, and that has its own problems, and there are feedback mechanisms, but those have problems, and so having a much more nuanced view of that is really important, and it can even lead us to a place where maybe we have a little more hope. So I find that extremely appealing. So we're here sneaking up on an hour, so I do want to bring this in for a landing. You kind of talked about where corporations are going, where executive compensation is going. What do you see the role of governance? Because we kind of touched on that briefly about the quality of governance. Is that getting better? Do you see that getting better? How do you see that fitting hand in hand with those other two topics?
It is improving dramatically year by year. Truly, 10 years ago, governance was barely a topic. And now every firm will typically have a governance committee on the board. It is part of the board. It's not required by the SEC, but they will voluntarily put it on there to make sure that from the board's perspective, the governance structure is working. That it is, for example, we have a succession plan for the CEO. That needs to be in there. That's part of good governance. How are we handling the diversity issue? Do we have a specific policy? Those are all indications, and I'm very optimistic about now that it has been brought out laid out on the table. I think it's going to just get better and better and better. For one thing, truly, 5-10 years ago, I don't know, we would have I offer a course in governance and ethics. I don't know that anybody would have even thought that. So, well, don't you do that in management? And I'm teaching it in the Fin group mainly because after the 2008 disaster, that was the financial institutions were the ones who could have used a little governance enhancement. So it got started there, and now it has just grown. And I think that's nothing but a good thing going forward.
My guest today has been Jim Owens. Jim, thanks for joining
My
us
pleasure.
on the EconBuff.
Good fun.
Thank you for listening to this episode of the EconBuff. You can find all previous episodes on YouTube at EconBuff Podcast. You can check out our website at econbuffpodcast.wixsite.com. That's WIXSIT.com. You can contact us at econbuffpodcast@yahoo.com.